And I'm gonna ask just a few questions about you as a trader. This interview, I want to use it to, enlighten those who are following you and other upcoming traders on what they should be looking for on the bright side of the trader. So I'm just gonna get into it. I don't want to waste your time, bro. So I don't know. Should I move on now?
Okay. No problem, no problem.
Yeah. So the currency merchant. What's the history of this name? The currency merchant.
Um, it was a name I selected based on me thinking that it just sounded cool. It sounded cool as a trading name. It highlights the fact that I'm trading currencies, and then merchant just sounds like lots of buying and selling, and that's what we do. So there was no like big meaning behind it besides that.
Yeah, that's cool. Were you an ICT charter member?
Yes, I am an ICT charter member. 2020 enrollment.
2020.
Yeah. Mm-hmm.
That's cool. So how long have you been in this game?
January 2024 will be my 5th or my 5-year anniversary. So I've been here for 5 years now. Well, 4 now, in January will be 5.
That's quite old, bro. So while you were starting out, did you discover ICT immediately or did you test other things?
So I didn't know about trading. So I didn't like make a conscious effort to, hey, I'm gonna be a trader or anything like that. I was literally at my day job, and a friend of mine, I just saw him marking stuff up on, what's it called again? Trading View. And being curious, I'm like, what's this? And he told me stocks and all that. And at that point, my only knowledge about stock trading was what I got from Billions, the series. So when he told me that this was something that you could do, and I saw what Bobby Axelrod did in the movie, I was like, this is something that I'd like to do. And immediately I started to learn, and he showed me, what's it called again? Andrew's pitchfork. And I was convinced that, hey, this is magic, because he said that whenever you draw the channel, price will always pull back to the midpoint. So, that was my first strategy, Andrew's pitchfork.
So were you profitable with this strategy?
What, say that again?
Were you profitable with the pitchfork strategy?
Well, at the time, I thought I understood what price was going to do. So for me, it was less about actually being profitable and more understanding what the markets are doing at that point, right? So I thought that markets are always drawn here. There were times when it worked in hindsight, and I did take some trades and it happened. But then whenever price would pull back to the center, my infancy was that it should reject all of that. So I wouldn't say I made enough money to consider myself profitable, but I did win some trades. Yeah, I won some trades, but I wasn't profitable.
Okay, that's cool. So what motivated you to choose ICT? Like there are a lot of great concepts out there. They have the BTMM, they have other price action, supply and demand. What brought you to ICT?
So the same guy at work that showed me trading and Andrew's pitchfork, sometime later, I don't remember exactly how much time, maybe a month, maybe 2 months afterwards, I saw him marking, the candles. Instead of using the pitchfork, he was now marking the candles and stuff like that. And I was asking him, why this candle? Because he had arrows drawn on, outlining what he wanted to see next and all that good stuff. I was like, why do you want it to come out there? And he was like, this is an order block. I'm like, what's an order block? And he was telling me that this guy called ICT, and he's a really good trader, probably the best in the world. And he has theory about order blocks. So he put me onto ICT YouTube and I started studying there. So my first introduction to ICT was from him. I didn't know about ICT. I didn't know anything about anybody who was trading or anything like that. I was literally taking his advice religiously. He said ICT, I looked at ICT. He said Pitchfork, I looked at Pitchfork. And I think that's what most persons, or that's how most persons start, because you don't know anything about the space. So whoever you see doing it, you would naturally, reach out to them for guidance. So he put me on the ICT, and that's why I started ICT.
Okay. So when you became an ICT charter member, did you feel like it was because you were under ICT directly that you became profitable, or was it because of the work you put in on watching his contents on the YouTube?
That's a good question. It's a very good question, because that question inadvertently addresses or asks another question about, is consuming content enough to be profitable? And my answer is no. So being an ICT charter member does not make you profitable. It does not guarantee understanding. Being an ICT charter member gives you access to the information. You still have to study, analyze, practice, backtest, and all that. So the opportunity is what ICT provided, and I'm forever grateful for that. Without ICT, I wouldn't have started on anything algorithmic. Or probably if I didn't join the mentorship, somehow I would have found ICT through the Instagram traders. And at that point, he was very active on Instagram. So I would have seen him and maybe been drawn to his YouTube. I don't know about the mentorship, because I think shortly after that, he closed off. But yeah, being a charter member or being in the mentorship definitely gave me access to a lot of information. But it is a lot of information. You still have to create your study plan and all that.
For you, it's the work you put into learning this that made you different.
Well, again, right? When you think about it, like just to learn ICT, that's not it. So the work I put in was not to learn ICT. Once you're in the group or you're in the mentorship, you automatically, I don't want to say live on his word, but you automatically watch every content he posts. So he did daily reviews, midweek reviews, and I think weekend reviews. You watch all of those. You watch all of those content. When he explains it, you understand. But in order for you to be able to see it live and read the tape, you have to go through that on your own. You have to go through that. So if I didn't join the mentorship and I had somebody close to me that shared information, or ICT's YouTube, and I put in the work, I believe I'd still be able to read the price action, but I just wouldn't have mentorship level access.
Okay, that's very nice. That's very nice. ICT is already a great trader, and we know that, and we know the influence it impacts on many traders. So, one thing I want to know is this: while you were learning ICT, did you consume all his content? Like, did you learn everything, starting from the Went series, the Scott Sniper series, and the Market Maker series? All of them. Did you learn everything from his library?
No, I didn't. And again, I think it's attributed to the fact that I learned, or I started trading, and ICT had all that information out already. Then 2 months into my trading, I believe it was 2 months in, because I think I joined September. I think I joined ICT September 2020, if I'm not mistaken. So at that point in time, I hadn't gone through all of his YouTube stuff. what I had seen is mainly what he was posting on Telegram and Twitter at the time. When I joined the mentorship, that's when he said that you should have gone through these series first on YouTube. At that point, I was like, maybe I need to catch up. But getting access to all the videos in the mentorship, I didn't really feel like going back to all of that until maybe a couple months in. A couple months into the mentorship, I'm watching all of the month one stuff, and I'm trying to put it into practice. Some of it not clicking. So whenever it's not clicking, I would try to look if there's anything I missed, or maybe he'll say something and reference an old YouTube video, and then I'd go back to YouTube and try to find that video. And I did get some insights from them.
So there are a lot of concepts to use. I want to ask you, do you apply all the ICT concepts in your day-to-day trading?
No, I don't. This is probably against or one of the most unpopular opinions, but I don't trade market maker models. I don't. I just don't. I don't think I need market maker models to understand the price action. So I personally, you will not see me trade in a market maker model, but if there's a particular price action and I'm talking to a group of persons and I believe it's easier to communicate with them by pointing to the market maker model, then I will do that. But in my own trading, no, I don't trade the market maker models. Fair value gap, fair valuation is probably at the core of my understanding, and I got that from ICT, how to understand fair value gaps and fair valuation.
Yeah, that's cool. So there are a lot of concepts that you apply on your trading that I've been questioning, and I wanted to know, how did you discover them? The 4 a.m. or I don't know, it's 4 a.m. or 4 p.m. I'm so sorry if I mistake it, but I know you use this concept, the 4 a.m. time and the 10 p.m. time. So I wanted to know this concept, how did you come about it?
In my studies online, way before ICT, I came across a lot of websites. Some of them you could recognize were rubbish, and then others you could recognize from the articles that they put out that these are genuine websites. One of the first websites I went to taught about stop ones and how to read stop ones and how to understand stop ones. After that, I learned a whole lot from CME's website. CME's website taught me about 4 a.m., 4 p.m., all that. So when ICT taught kill zones, and he said, this is a time window that gets you close enough, I'm looking at it like, well, 4 a.m. is smack in the middle of that. Well, not, or maybe not exactly in the middle, right? But 4 a.m. is in the middle of that kill zone. All the other kill zones, they have specific times in there as well. So I'm saying to myself, if I have a kill zone or a window of time, and I have reason to reference a specific opening price, that can help me to refine what I'm looking for and help me to refine my stop loss. So I blended 4 a.m. with ICT for the longest while, and then I just cut out the kill zones because I was form fitting my trades too much around kill zones. But once I stuck to just the opening price at 4 a.m., I realized that I got all the precision I need from that.
Yeah, that's cool. So just a quick question. Do you use the 4 a.m. time as do you use it with respect to the Judah swing concept from ICT?
No, I don't.
Okay, so you don't use it like a Judah swing.
No, I don't.
Okay, that's cool. So another question. When you got into the ICT charter member, how long did it take you to become a profitable trader?
8 months.
8 months.
Yeah.
Did you blow accounts while doing this?
Of course. um, My very first trading account, I started with $16, I believe. And I brought it to $64 in the first day. And I blew it sometime in the week. So that kind of motivated me to say that, hey, it's possible to make money, but it's also possible to lose money. And then the very account after that, a good friend of mine funded it. He funded my trading account. And of course, I blew it too. I blew that too. And yeah, the reason I blew the account, I understood maybe about 3 to 5 weeks after I blew the account, I understood why I blew the account. I blew the account because once I learned order block and I looked at order blocks in hindsight, I studied wrong. So instead of approaching backtesting with a rules-based approach, I would only go back to old data and look for big moves and then look for the down candles before the big moves. And then tell myself that, hey, that was an order block and it worked. So now whenever I see a down candle, I'm thinking, buy the order block. It worked a couple of times until I got stopped out of a trade, but the market was still inside the order block. So I entered with no stop loss. And then the market, tanked. So that's how I lost my first account. And I spent a couple of days contemplating why was that down candle not on order block. And after hours and hours of studying and revisiting that day and then analyzing price action over and over and over again, I realized that that was not an order block, but I was convinced it was going to be an order block in real time. Because in hindsight, you could see that that was several down candles. So clearly that's not an order block. So I said to myself, the order block I was trading was not valid. So I need to understand how to validate an order block. And then that kind of led me into creating, I want to say my own theory, but it's derived from ICT, right? So ICT order block theory, in order for me to validate when I could use it, I created a theory around it and it works. It's been working.
That's cool. So, what's your own model like? When you come to ICT, he has the 2020 model where we use the fair value gap to enter, and also the break and fair value gap to enter. So, what's your own model like? What do you want to see in price to enter price to make an entry or place your stop loss?
Okay, so that question is probably one of the main or the most misleading questions that traders try to answer. And I'll tell you why I'm saying that. If somebody asks you, what do you look for to enter the market? And you give them any kind of response that's structure or structurally based, you're telling them that you trade a pattern. I don't trade a pattern. My entry or my confirmation is always going to be in line or with a high probability against the order flow. So before I go to a chart, I already understand what's the order flow. I don't go to a chart at 8 o'clock and start thinking about order flow. And even if I did, it will still derive from what's the order flow. So once you have the order flow from the daily chart, it's either bullish or bearish, and you're then asking yourself, what do I want to see to get a trade in line with the order flow? If the order flow is bullish, what do I want to see to be bullish? At that point in time, once my order flow is determined and I'm only thinking about entries, that's when I'll look at something specific on a chart. That's when I'll look for the range we're trading, the efficiency of the range. And then based on the range and its efficiency, I have a specific criteria that says, this is what you want to see to take a trade. If it doesn't happen, that's it. No big deal. whatever the outcome is after I've determined what I want to see, it's more tape reading than pattern driven for me, if that makes sense.
That makes sense. So basically your entry or your model, it all depends on what price is doing.
Yeah, because we trade price.
Yeah. So you want to see price respond in your own bias to make an entry.
Yeah, that's a nice way to put it.
Okay. That's cool. So you made um a very mind-blowing challenge. You grew an account from $22 to $22,000. Is there a secret? Is there a plan that you followed? Like what motivated you to do this and how did you do it?
So if you have a small account and you're trying to grow it, and you're thinking about what would be the highest possibility and probability trades to take, the answer should always be a large price swing. If you have a large price swing framed from, let's say, a daily chart, and you get in and you're able to get in again on retracements, all you have to do, if you're correct with your bias, is hold that trade. And then once it moves in your favor enough, that will create margin for you to repeat the same process on a different pair or another day with increased risk. So when I started the account with $20, my lot size was 0.1 because that's the smallest my broker allows me to go. But I also had a gold trade that I perceived to be a large swing, and I entered with 0.03. And as the market moved and I built leverage, I scaled in and I added another position. It's very aggressive, I know, and I understand, and I'm fully aware that if I lose this trade, then that's fine. I'm okay. I can take a loss. So it's a calculated risk to hold a move for 4 or 5 days on a swing and trust your analysis. That's what I did. Now, to kind of bring that full circle, I didn't randomly pick get up and say, I'm going to do this today. I picked a day and a week where I believed we were going to have a very large down move on NASDAQ. And I held all of that move. And that's kind of what bolstered the progress and made it even faster, if I say. Maybe, yeah, made it a little bit faster than expected. The plan wasn't to do it in 1 day, 1 week, or anything like that. The plan was just to trade. But then those large moves, a large move in gold when you have multiple small lots, and a large move in NASDAQ when you have multiple small lots, those will compound an account really fast. And that's what happened for me.
So you're basically saying for you to be profitable, you have to have the ability to add to your winning trades.
I'm saying for you to be profitable, you have to be able to identify when the market is in a high probability state to move in a large range. That's why we don't trade consolidations, because we don't want the market to trade 5 pips and then 5 pips back down. We want to see a one-sided market, and we want to hold that move. Most traders who go into a trade, even with a set pip objective, they still look at the potential for holding that trade for a long time. So start with identifying where is a large swing likely to unfold. When would be the ideal point to get in and hold for all of that move? And then from there, it's controlling yourself, controlling the risk, and trusting your analysis.
That's nice. But we know that this game is more about psychology than technicality. So you probably have the ability to swing. What if the person doesn't have the ability to swing for those large moves. Some of these beginners, they can't hold on to positions. So what's your advice to them? How can they control this?
Okay. I like that question. I like that question because maybe 2 years ago, maybe about 2 years ago, 2 to 3 years ago, I had the same problem. I wanted to be an intraday trader. I wanted to scalp in and out and be done because I had a job. But at the same time, I wanted to make a lot of money. So that's a paradox. As a scalper, you want to be in and out of the market, but you want to make a lot of money. That is going to automatically lead you to trying to put large lot sizes on small moves. And that can hurt you real fast. So for me, I would get really good entries and then the market runs in my favor. And then while it's running, instead of me saying, that's good enough, Kish, you had a good day, or that's it for now, wait for something else and add again, I'd always be hopeful. Whenever the trade is good, I get hopeful. This is going to be that trade that does, 1 to 100R, because that's what I used to see on IG and all of that. So I reached out to ICT and I said, hey, I'm finding that I have good entries, but I have bad exits. And his advice was to remove the question. Just set preset targets and remove the question. You're in a trade, you're going to exit. Okay, 20 pips is a good objective. Get out at 20 pips. 30 pips is a good objective. Get out at 30 pips. Don't go into the trade and then think, oh, this one is moving. I wanted 5 pips or I wanted 10 pips, but because it's not moving and I'm winning, I'm going to get 50 or 100. That's madness. So I started scalping aggressively. So there were days when I would literally take over 100 trades, moving on a small account from maybe $10, $20 up to $100 in one day. Just small, consistent strikes. And then you start realizing that it's a lot of work. So you need a way more consistent approach. So you play around with numbers. And I came up with the idea that if I had any account, and I wanted to double the account, I'd need to make 2% for 36 trades with a 100% win rate. And I could double that account. Play around the numbers some more and you realize that a higher percentage gain and a short amount of wins with consistency will exponentially grow that account. So I became a velocity scalper. I started using maybe like a $50 account, and I would use 0.05. And when it runs 15 pips, I would scale out 0.03, leave 0.2 running, or 0.02 running for, I don't know, another 20 points. Then I scale out 0.1 and then leave one running forever, or it got stopped out. So that kind of conditioned me to get in a move, allow it to expand, pay myself, leave something running. If it continues to run, take something off again, leave the rest for like the daily objective or a large swing. And as I got consistent with that, I'd get stop out on moves that I already took partial. I lost that trade. I'm thinking, I'm glad I came out with something. Because if you have a $50 account and you put 0.05 on and it runs 15 pips, you take out $5 profit and it comes and stops you at break even, you're up $5, plus or minus commissions depending on your broker. So that's 10% that you just made. So now instead of trying to get back in, I'm now thinking, where can I find a move that could get me 15 to 20 points, 15 to 20 pips? Because I wasn't trading indices at the time, I was just trading Forex. And then that kind of conditioned me to look for moves that are likely to expand. So then I started look at aggressive pairs, gold, GJ, CHF, God forbid that pair. And any pair that I thought would be fast, I'd go on the internet and do some studies about the fastest pair. They would say, oh, JPY was a very volatile pair. I played all of those volatile pairs. And the volatility was there, but then the volatility wasn't always with me. And then I got another mentor who advised that based on the time I had available, because I was working in the day, I was only available for afternoon, he suggested trading AU. AU was a little bit slower, but it moved 15 to 20 points. And because it took so long, it felt way more rewarding waiting 15, 20, 30 minutes for 15 pips than being done. So again, the discipline came up. Outline the move, get in, manage the risk, pay yourself. Forget about what happens after that. And then when you know that when you're trading Asian, if you get the low of Asian and it runs higher, once it creates the low, it's probably going to take the, well, I mean, once you get in at the low and it creates the high, you're probably going to get taken out at break even. So then trading AU kind of showed me that the strategy I had to pay myself on partials was good, but I could pay myself partials and trail my stop, expecting to get stop out. And you do a lot of that, and you see the results and you're like, yeah, this could work. And I did that for the longest while.
That's cool. That's cool. So basically one of the best way to tackle this is learn how to pay the trader, and
100%.
And you have to overcome the fear of leaving money on the table.
Yes, you have to know how to take a loss. You have to understand when risk is elevated. So just get out. Simple. Just get out. Risk is elevated, get out of the market. That's it. What makes it the risk elevated? Find out why the pair that you trade moves. What makes it move? What makes it really, really move? Like for NASDAQ, interest rate does wonders for it. So yeah, just find out what makes the pair that you trade move.
That's cool. So one last question. How do you handle your losses? And while you are growing this account, where are you using stop loss? And when you hit the stop loss, how do you handle your losses?
So I was using a stop loss, because you always use a stop loss. And for the trades that I lost, there's nothing to handle about them. That's just a loss. I don't lose faith in my system. I don't change my plan. A losing trade is just a losing trade. That's it.
So every trade you entered while growing this account, you had the stop loss.
Yeah.
So
why would you not have a stop loss?
Yeah. So when you hit your loss, you do reduce your risk, or you increase it to cover it back and get more? What do you do?
I don't increase my position when I take a loss. I don't necessarily decrease it as well, and I'll tell you why I don't decrease my lots. Risk management is one of the things that you don't have a lot of sensible information on it, right? You don't have a lot of sensible information on it. And when I say a lot of sensible information, this is what I mean. There's a lot of information that says you should trade like this, and it tells you how you should manage your risk, right? But here's the thing. Most of that advice that you're getting it from somebody who is trading a much larger account, probably somebody who's funded, and they're telling you to risk 0.5% of your account, and my account balance is $50, $10. I can't reasonably risk 0.5% of that and expect to have a reasonable return. So I don't look at it like that. I look at it like, if I lose this trade, how much am I allowed to lose? How much can I lose if I take a loss here? So in order to do that, I want to know that if I lose this trade, I can enter another trade. So I learned about margin. How much of my balance does it take to open a particular position, a particular lot size, and a particular pair? And then that kind of told me how much I can lose and how many losses I can take before this account is useless and I have to switch pairs. So you base your risk on money when you're trading a small account. Unless you're going to go to demo and practice on a large account, I believe you should focus on a fixed risk. So you're trading a $100 account. I think $5 is a decent amount to lose. $10 if you're aggressive. So if I take a $10 loss, cool. What lot size am I going to use to match my stop so that if I take a loss, it's only $10? And then you put that together, and that's it.
That's actually cool. That's a gem, bro. So basically every person's risk management are different.
It has to be. Your risk management has to fit your personality, or you're trying to trade somebody else's plan.
That's great. So just I want you to use 1 minute and tell your followers, like those following you day to day while you call price, like give them what is the best advice you could give them. Is it to go into the YouTube channel, ICT YouTube channel, and study more? Or is it to focus on one model and make it work the way they suit, the way their psychology suits? Just a 1 minute advice.
In 1 minute, I'd say forget about patterns and start learning to read the tape. What condition are we in on a higher time frame? Is the lower time frame supporting that? So if the higher time frame is in a expansion, what are we getting on a lower time frame? What's the order of the delivery? Do we get opposing liquidity runs and then market structure shift? Things like that. Focus on the order in which price is delivered and stop looking at there's a PDRA alone. That's really going to be the game changer, I believe.
Yeah, that's amazing. The currency merchant, it's very amazing to have you here. It's night in Nigeria, and I know it's actually afternoon in New York. It's very amazing to have you here, bro.
My pleasure.
I hope to have you next time you tune in, and I hope to make this video go viral so that a lot of traders out there can hear this sweet information you're passing to them.
All right. I'm happy to help and wish you all the best on your journey, bro.
Yeah, thanks, and be safe.
All right, enjoy the rest of the day. Bye-bye.